Welcome. I'm Scott Hodge, president of the Tax Foundation. On behalf of our sponsor, the Tax Institute at H&R Block, I want to thank you for tuning in to another of the Tax Foundation's Talking Tax Reform events on some of the most topical and interesting tax issues of the day. Today, we're going to explore the lessons learned from the various COVID-19 relief packages and their impact on taxpayers. One of the challenges that Washington has had over the last year is how to get relief to the right people in the most efficient and effective way, while at the same time trying to minimize the compliance burden on both taxpayers and, of course, the administrative burden on federal agencies such as the IRS. And we're going to ask our panelists today, well, how did they do? How did policymakers do in those goals? And how should the lessons that we've learned over the last year inform how the next relief package is designed? But before we get to our all-star panel, let me bring us up to date. It's hard to believe, but at the end of February, we'll mark the 1-year anniversary when Congress first took action on COVID relief. As the Business Insider reported on March 4th of last year, quote, the House voted to approve a roughly $8 billion emergency funding deal to address the coronavirus on Wednesday, the latest step in a race to contain the outbreak that has killed nearly a dozen people in the United States. Since then, we've lost over 400,000 people, while Congress has enacted 4 much, much larger relief bills. And that includes the $192 billion Families First Coronavirus Act, the $2 trillion Coronavirus Aid, Relief, and Economic Security Act, or CARES Act. You'll hear a lot of that today. The $483 billion Paycheck Protection Program and Health Care Enhancement Act, say that 3 times fast, and the $868 billion Consolidated Appropriations Act of 2021, which of course was passed in December of 2020, only in Washington. And that brings the total amount of COVID relief to about $3.5 trillion, according to the Peterson Institute, although $4 trillion, according to the Committee on Responsible Federal Budget. And according to my mom, it's just a mind-blowing amount of money. And I always believe my mom. Well, before I introduce our panel, let me warn you that we are broadcasting live here from Washington, D.C., where acronyms are a second language and somewhat of an art form. So you're going to hear a lot of acronyms today. And so if you're taking notes at home, here are a few. EIPs, you'll hear that, economic impact payments, or actually the recovery rebates, many of you know because you got one. These are the advanced refundable tax credits of $1,200 that you may have received last year, or the $600 stimulus checks that you received more recently, which soon could balloon into $2,000 checks. Then you had the PPP, the Paycheck Protection Act, don't say that 3 times fast, which gave forgivable loans to largely small businesses and got a few headlines along the way. The ERC, the Employer Retention Credit, which was a refundable credit that businesses could take against some of their employee costs, like payroll costs and so forth. You had UI, which many of you know is unemployment insurance. CTC, the Child Tax Credit. CDCTC, I can only say that slowly. Elaine will pronounce this much better than me. It's the Child Independent Care Tax Credit, the EITC, the Earned Income Tax Credit, and NOLs, net operating losses. Now, you already know the CARES Act, as I mentioned, but along the way, the House passed the HEROES Act, and the Senate passed the HEALS Act. And that's not the heel on your foot. It stands for something about healing people. And our panelists may mention those along the way. Although both of those bills failed to get support from the other chamber, many of the proposals in them, such as the expanded child tax credit and earned income tax credit, are now back in play once again. Now, you might hear something about the PATH Act. And that was a deal that was cut at the end of 2015 between President Obama and the Republicans in Congress, which expanded many of the tax credits I just mentioned. Now, if this weren't overwhelming enough to follow, all of the relief measures that were passed last year are going to have a really big impact on the tax filing season that will begin in just a few weeks. Now, if any of this is really confusing, like it is for me, I encourage you to come to the Tax Foundation's website, where we have a COVID-19 resource center and FAQ, which explain all of this. Now, with that as your guide, let me introduce you to our panelists today in the order in which they'll speak. First up is our friend Kevin Martin, who is a principal tax research analyst at the Tax Institute at H&R Block, and which of course is our sponsor for today's event. And next up will be our friend Elaine Magg, principal research associate at the Urban Brookings Tax Policy Center. Last will be Erica York, an economist here at the Tax Foundation. I say here, but actually Erica lives and works in Kansas. And let me warn you, speaking of Kansas, all of our panelists have a Kansas connection and are rooting for the Chiefs in the Super Bowl. So please don't let that color any of your reception to their comments. And as you can see, Kevin is loyally displaying his Kansas City Chiefs helmet right over his left shoulder. So with that, Kevin, kick us off and tell us how taxpayers, many of whom are your clients, are impacted by all of this.
Well, thank you, Scott, for that introduction, and thank you to the Tax Foundation for inviting me to speak here today to discuss the lessons learned through the various bills and laws that have passed since this coronavirus pandemic began. I really want to focus on 4 specific items, and those are EIPs, or economic impact payments, as Scott pointed out, and how they've been processed. Secondly, I want to talk about the Paycheck Protection Program loans. Specifically, I want to talk about the expenses that those loans were used to cover and how that demonstrates some of the lessons learned throughout the process of this. The third thing I want to talk about is the new charitable deduction, a smaller part of it, but important nonetheless for seeing lessons learned. And the fourth thing I'm going to discuss is the Earned Income Tax Credit, or EITC, look back, which was an expansion done as part of the Consolidated Appropriations Act just last month. It's going to be very impactful for taxpayers and something that also vividly demonstrates the kind of lessons we can learn going through this, because it gets cliched and it gets said a lot, but a lot of this is really unprecedented in terms of the scope and the magnitude of a lot of these changes, and keeping up with them can be difficult at times. So EIPs, obviously a massive part of the federal response to this crisis. So in just the first round of payments, the $1,200 payments, over $125 million were sent out. And that is a full-time administrative and processing responsibility for the IRS, who is certainly capable of meeting the requirements to send those out both effectively and in a short order and timely. And I'm sure you all recall the primary emphasis, or the real focus, was to try to get those payments out as quickly as we possibly could. And as a result of that, some of the typical IRS quality control and processing measures were truncated or shortened. And while most people got their payments without any issues and in a timely fashion very quickly, there were many, many who did not. And looking forward, what kind of items can we do, what kind of processes can we put in place, and what kind of checks can we put in for the IRS to help them process these payments so that they both go out timely, but also that we avoid mistakes. And H&R Block, as part of an industry coalition, recently submitted a letter to Capitol Hill, and we made some suggestions for not new processes, but existing processes the IRS has in place for when they go through the normal tax season, or when they issue payments as part of PATH Act refunds, so things like the Earned Income Tax Credit that require additional anti-fraud measures to check their veracity. one example of the type of checks that I'm describing would be something like a controlled launch, where a smaller subset of the payments are sent out after they're approved. And then that way, any potential problems with the processing are identified early on, and those problems can be addressed when there are only hundreds of them as opposed to thousands or potentially millions of them, with a large batch send out or something like that. These, and also one other thing in regard to EIP to be cognizant of is there are other important deadlines that the IRS has to worry about. I mentioned the anti-fraud measures that were put in place under the PATH Act, and under that act, certain refunds, notably the EITC, can't be sent out until a set date. So, for example, if you have that set date, which is in the middle of February, and you can't even begin to process these returns until that date, and then another piece of legislation gets passed with EIPs in them, that's creating additional work for the IRS to process those, and that could potentially lead to delays. And Commissioner Rettig just recently had mentioned that in the event of a third EIP payment during season, he couldn't necessarily guarantee an April 15th deadline. And I'm selfish, I suppose, in a way, but as someone who works in the tax industry, I'm not super excited about another lengthened tax season. But that is definitely something to look out for the future. Moving on to the PPP, Scott talked about it in his introduction, but it was a large loan program. Over 5.2 million loans were sent out just in the first round of this program. And there was just another round of nearly 300 billion in funding in the most recent act. And these loans were eligible to be forgiven if they were used to cover certain expenses. So essentially, the loan at that point, if it's forgiven, becomes like a grant. Now, typically, when you have forgiven debt, whether you're a corporation or a partnership or an individual, you have to report that as income. Well, the CARES Act, the act passed back in March, it created an exception where the forgiven income under the CARES Act or under the PPP was not included in income. And so that's a benefit for taxpayers, obviously. But then the question arose about the expenses that you were paying, using those proceeds to pay for things, most notably payroll. That was the main thing that the PPP was designed to cover, was the cost of employees and things like that. So these are things that a business would typically deduct on its tax return. And so the question became, well, can we still deduct these expenses that we're using the PPP to pay for? And the IRS issued a notice on it. And it was an open question for a long period of time until the IRS issued a notice making it explicit that you could not deduct those expenses. Now, this created somewhat of an issue with some lawmakers. And in the CAA, the most recent law, they made it clear in the law that they wanted the PPP expenses to also be deductible, thus creating a sort of double tax benefit. So you could take a tax-free grant as a business, and then you could also deduct the expenses that you use those grant funds to pay. So that was what a lot of lawmakers said their original intent was. But the IRS, when they came out with the notice, was constrained by what the rule was. And the rule, as it existed and as it had been practiced for many years, was that if you have expenses as a business that are covered with tax-free funds, then you're not going to be able to deduct those expenses. And so a lesson learned here is really making it explicit or clear in legislation what the rule is, rather than relying on administrative organizations like the IRS to issue guidance and hoping that they will follow intent of whatever that body wants to do, because intent is often much more difficult to parse than the words themselves of the statute. And speaking of administrative guidance, one lesson we have seen from all of these acts is an almost unprecedented amount of IRS FAQs and informal guidance issued to cover a lot of the gray areas that can come anytime a 1,000-page piece of legislation is passed, because inevitably questions arise for specific areas of interest and things like that. And that was one of the main focuses of the law. The third thing I want to talk about is the charitable deduction. It's a much smaller program than the PPP or the EIP. It's a $300 deduction, and it may not seem like much, just by itself. But I think it's illustrative of an important lesson that we might learn in the future. After the Tax Cuts and Jobs Act, the big tax legislation passed in 2017, roughly 8 in 9 people who file don't itemize their deductions. And if you don't itemize your deductions, then you're not getting any tax benefit from donating to a charity, at least until this law passed. It's a small benefit. It's $300, but it's an above the line deduction, which means those 8 and 9 taxpayers who don't itemize can take this deduction if they donate to charity. And a lesson that I'm going to learn or try to gather going forward is to see what effect this has on charitable giving, whether or not we see charities receiving a lot more smaller donations like that, and also from a client perspective or a taxpayer's perspective, whether we see a lot of individuals taking advantage of this and taking this deduction on their return, and showing that there are always open questions for even these small law changes. In 2021, married couples will be able to deduct up to $600 without itemizing. That was a change because under the CARES Act rule, you could only deduct $300 even if you were a married couple. So single and married were subject to the same limit. So our understanding of the law is always expanding, it's always gaining, and it's definitely something to watch going forward. And the last thing I want to mention is the Earned Income Tax Credit look back. This is a program that existed prior to all of the new laws. It was mainly designed for disasters. So if you had a natural disaster happen and caused you to not be able to go to work, or your business was destroyed or something like that, you could look back to the prior year, essentially use that income to determine your credit amount, specifically for the Earned Income Tax Credit. Now, this might seem counterintuitive. Why would it be beneficial for me to look to a prior year when I had higher income? And why would that result in a bigger refund for me? Because a lot of people associate more income with lower refund or higher taxes. Well, the way the Earned Income Tax Credit works is up to a certain point, if you're earning more earned income, you're getting a higher credit. And the Earned Income Tax Credit is a huge credit for a lot of people, and a lot of people lost their jobs during 2020, or were forced to take unemployment compensation, which, while taxable, doesn't qualify for this. And so that look back allows them to potentially get a credit that's hundreds or thousands of dollars more than the one they would qualify for if they were not eligible for that look back. And this was a program that maybe thousands of people used before, but potentially tens of thousands or millions of taxpayers could benefit from this look back now that it was included in the CAA. And a lesson to be learned from here is the tax code is really big. And because it's really big, a lot of times the answer you're looking for in terms of a solution to a problem may already be there, but just may be accessible in a different form. And in thinking about it creatively going forward is something that's going to help us better tailor tax solutions to taxpayers individually, and help get them through any crisis that comes up, including the coronavirus. With that, I think I'm going to turn it over to Elaine, as I've probably taken more time than I already should have.
No, that's great. Thank you very much, Kevin. And Elaine, take it from there.
Great. So first of all, my thanks to Tax Foundation for hosting this event, and for H&R Block for helping to sponsor it. It's always fun to get to talk about these issues. So what I want to sort of focus on is that we had this massive problem, and a key to solving our problems is having regular income received throughout the year in some sort of stable fashion. So our well-being is largely defined by our ability to pay rent, afford childcare, buy groceries, and these are recurring expenses. And particularly for low-income families, they're already in a situation where incomes are bouncing around a lot. And then on top of that, we have this pandemic hit. So we saw tremendous job loss and economic disruption, all in a world of great uncertainty, right? Scott's statistic that we were starting to get concerned about those first dozen deaths was just, overshadowed by what it, became. And so in Scott's mom's vernacular, this is mind-blowing what's happening. So we see businesses shutting down. We see other places have to shut down because people are no longer coming to them. And so we see this steep rise in financial vulnerability. Jobs are down all over the place. The unemployment rate by April of 2020 is still 15%. State and DC have unemployment rates that are bumping up to 40%. So these are just a shocking string of events, and we're forced to sort of look at. I think my audio maybe just bumped off.
I think you were breaking up, Elaine. So if you want, you can back up a little bit and start again.
Yeah, okay. Let me try again. So we're in this moment of just extraordinary turmoil, and we have to look at what solutions do we have available. So in the US, we basically have a social insurance system, which is sort of unemployment and Social Security. We also have traditional transfer programs like food stamps, and we have our tax system. And we responded in all of these areas. And I'm going to talk a little bit about why we needed to respond in all these areas and what the tax system's role in that was. So we have to lean on so many systems, even because it's largely a story of unemployment, because our unemployment insurance is designed to provide replacement income for people who lose jobs through no fault of their own. But it's not wage insurance. So in some cases, people are left out of UI. They might have been reduced to part-time hours. They might be working multiple jobs and seen a disruption in just one of those jobs. They might also be unable to look for work, which is another requirement for UI. So unemployment insurance simply isn't touching everyone. It's also not designed to replace all of your wages. And so you might be getting on average about 40% of what you were earning beforehand. So we adjusted the unemployment insurance on several fronts, including adding additional amounts to paychecks, but it still didn't touch everyone and cause everyone to be whole, because some people still just weren't eligible for the program. So it was UI's moment to shine. It did a good job in a lot of respects, but it still left a lot of holes. And so we end up coming to our tax system, and we don't have a system designed to deliver payments rapidly to almost everyone. And so those CARES Act payments that Kevin discussed become incredibly important to people, but they have their shortcomings. First of all, like he mentioned, not everyone got one. At the Tax Policy Center, we estimated that there were 20 million dependents who simply didn't qualify for the payments. These are 18 and 19-year-olds. They are full-time students who are claimed on their parents' returns, and they're older dependents who may be disabled. Those are also the people who are likely to be missed by UI. The CARES Act payments, though, although Kevin is correct that in some cases were delayed, as someone who's watched payments go out over time, I thought these were lightning fast, right? On March 24th, legislation is passed, and a couple weeks later, money starts arriving in people's bank accounts. But not surprisingly, the IRS is really good at getting payments to people who are middle income, they file tax returns, they have updated information, IRS, but it doesn't reach every, we still see, and about 75% of the people in this project I'm working with actually received an economic impact payment.
Oh, hang on.
I don't know why that happened. My internet is very unstable. I apologize. So it's sort of the project I'm working with DC, where 75% of people receive payments, speaks to who gets left out. And the people who are left out are generally childless people who do not have, who are very low income, who don't have a strong connection to the tax system. They don't file to get child tax credits because they're not eligible, and the earned income tax credit that they're eligible for is very small relative to the support for families with children. We also, as I mentioned, have a SNAP program. We did increase benefits there, but again, transfer programs just don't touch everyone. And that is why all of this, big heavy lift ends up falling on the IRS, because they're sort of the best equipped, even though we know they're not fully equipped to distribute large amounts of new sources of income. And looking forward, we're already talking about the tax system as being a key player in stability moving forward. So there's an expansion to the child tax credit that's being discussed. If enacted, it would lift 45% of children who are currently in poverty out of poverty. It would also be a very expensive program because the child tax credit goes to almost every family with a child, not just low-income families. There's an expansion to the childless EITC being discussed. Right now, these folks could get a payment of about $500. Under the expansion, that would rise to about $1,500. The second benefit of this, if it can be called that, is it would likely bring more of these very hard to reach people into tax filing. So in the future, we're better able to deliver payments like these. There is also an expansion to the child care credit being discussed. This one, in my view, will not be really addressing the cash flow problems people are experiencing right now, because it's paid not contemporaneous with when you need it. And our childcare problem right now is not an inability to afford childcare. It's that our children are unable to go to where childcare is offered. So for example, my children are at home with me all day long. So I think it's understandable why we end up in the tax system. It can be a very blunt tool, which means it can affect a wide range of people. But the cost to that is, because it's blunt, benefits tend to spread out to people who are not maybe experiencing deep need right now. I have been inspired, though, by how efficiently the IRS has been able to deal with the first round of payment and now a second round of payments. But I share Kevin's concern about if we keep starting and stopping these payments in the middle of a tax season, that's very burdensome for the IRS. If instead we enacted some sort of recurring type of payment, it could almost be on autopilot, much like Social Security or SNAP benefits are on autopilot, which would ease that administrative burden for the IRS. And with that, I'll turn it over to Erica, and apologies for the computer issues.
Well, thank you, Elaine. No, and I want to come back to a couple of those issues because those are interesting ones that you pointed out. Erica, take it away.
Yeah, thank you. And thanks to H&R Block for helping sponsor the webinar. So as Scott mentioned earlier, Congress acted with remarkable speed and with record levels of fiscal support in response to the pandemic, especially early on. The CARES Act and other programs in early 2020 brought fiscal support to about $2.5 trillion or 13% of US GDP. And since then, of course, Congress passed another about $900 billion of relief, or roughly 4% of GDP. So the total amount of support we've seen surpasses $3 trillion in less than 1 year. And that in and of itself is pretty remarkable. The sheer size and scope of all of that legislation creates many different learning opportunities for policymaking, and we've already heard a lot about that. I'm going to focus on two areas: the trade-offs between speed and targeting, which Elaine kind of touched on, and then the distinction between relief and stimulus and the implications that those two ideas have for further efforts. So some of the issues that were experienced with the different policies have to do with trade-offs between getting relief out really fast versus trying to track down specific populations of people that need relief. The best example of the former is the economic impact payments. The CARES Act payments were enacted at the end of March 2020, and the first payment started hitting bank accounts just 2 weeks later. The second round of payments was signed into law on December 27th, and payments began on December 29th. And within about 10 days' time, the IRS had sent out more than 100 million payments. In the past rounds of direct payments, like we saw in 2008 and other economic crises, the timing from enactment to distribution varied from about 1.5 months to more than 2 months. So the most recent round of payments definitely checked the speed box, but they also didn't necessarily target a specific population, and there were some mistakes made in the delivery. The only real targeting of the payments we saw was excluding about the top 10% of taxpayers by using income phase-outs that began at $75,000 for single filers and $150,000 for married filers. The payments weren't limited to the jobless or to low-income households, and since the IRS had to rely on past year's tax returns, the payments weren't targeted at households that lost income in 2020 because the IRS didn't have a way to determine who had lost incomes. And many mistakes were made along the way too. With the most recent round of $600 payments, the IRS actually in a statement said because of the speed at which the law required the IRS to issue the second round of EIPs, some payments were sent to an account that may have been closed or is no longer active or is unfamiliar. The IRS worked to resolve that, but the trade-off between speed and accuracy and targeting is very clear with those payments. Likewise, in the first round of payments, we saw a backlash to the fact that some deceased people received them. By the end of April 2020, more than 1 million decedents had received a check. And then the IRS requested that that money be returned, and that led to a huge amount of confusion for taxpayers. So improvements can definitely be made, and we saw some improvements made with the second round of payments. For example, Congress added some guardrails for the issues of payments being sent to deceased people. And we can also think about better information sharing across agencies and better IT infrastructure. But I think one key takeaway is that when we're talking about 160 million payments being made within a few weeks, that in and of itself is a remarkable feat. And for a trade-off of less precise targeting, some mistakes are bound to happen. And that's okay because the goal of getting payments out fast was achieved. And we can also look at some of the more targeted forms of relief. For instance, the CARES Act created the Paycheck Protection Program, various tax credits for employers and small businesses, and unprecedented expansions of unemployment insurance at the federal level. These programs were much more targeted than direct payments to 160 million households, and their rollouts took longer and experienced more issues. Some of the tax credits provided in the CARES Act were used less than expected, partly because of administrative delays and outdated processes for receiving tax refunds. Such processes and other administrative challenges should be evaluated and improved upon. And then other reasons for low take-up of programs like net operating loss carrybacks and the employer retention tax credit were due to interactions with other parts of the tax code. On provisions for individuals, unemployment was expanded to gig economy workers and others who don't normally qualify for unemployment insurance. It was topped off by a federal supplement of $600 through last summer and now $300, as well as some other changes. The UI expansions had to be coordinated with states, and I won't get into the nitty-gritty here, but systems and technologies across the states vary, And those challenges made it hard for eligible recipients to actually access their expanded benefits in a timely way. And besides policy differences and serious technical errors, the expansion to gig workers and others was essentially asking states to create a brand new program in the middle of all the chaos that was already happening. Even now, there are states still waiting to roll out the most recent expansion of pandemic unemployment insurance programs. So people are still waiting, even though it's been almost a month since that was signed into law. Across all the problems the more targeted programs experienced, we can learn at least 2 lessons. First, that financial support for systems, upgrades, and IT infrastructure shouldn't be ignored in good times. And second, the problems also show a serious need for simplicity within the tax system and other benefit programs too, both for easier compliance on the part of individuals trying to interact with the systems and easier administration on the part of IRS or other government agencies that have to enforce the systems. The complexity of targeting programs and trying to track down these households that are harder to reach or people who don't interact with the systems normally also have important implications as policymakers look to expand the role of the IRS and the tax system in the future. But in the big picture, by providing a mix of quick and broad relief and targeted and somewhat slower relief, Congress did, for the most part, successfully address the crisis, at least in early 2020. And that brings us to the distinction between relief and stimulus. So stimulus generally refers to short-term policies that are designed to either increase people's or businesses' economic activity, like trying to get them to work more or spend more or hire more or invest more. And the idea is that in the short term, such activities will have a multiplier effect and increase GDP by more than it would have grown in the absence of the policies. That contrasts with the idea of relief, which in the current pandemic environment is designed to bridge gaps of financial hardship caused by reduced economic activity. And that's because of the pandemic or formal health guidelines that require businesses to close down or place limits on economic activity. And that distinction between stimulus and relief matters when we're thinking about how to design policies and how to evaluate their effectiveness. So the CARES Act and the other policies that we've seen enacted so far are largely intended as relief measures to help households and businesses that were financially burdened by either providing those direct payments, enhanced unemployment insurance, forgivable loans, tax payment delays, and various other measures to improve liquidity. In the aftermath of CARES, the amount of saving in the economy nearly tripled over the first 2 quarters of 2020. On an annualized basis, went from $1.6 trillion in Q1 to $4.7 trillion in the second quarter. Part of that was due to decreased consumption as people stayed home and didn't go out to restaurants and that sort of thing. But part of it was also due to increased personal income. So even though wages fell and business activity and profits fell, that was made up for by the government's fiscal policies. The higher savings had beneficial effects in capital markets, and additionally, estimates show that the poverty rate actually fell by 1.5 percentage points from January 2020 to June 2020. And this morning we saw final numbers come out on the economy for 2020. GDP fell by 3.5%, but personal income rose by a little more than 6%. And that points to the policies being enacted in 2020 as a huge success for achieving relief in aggregate, at least through the first half of the year. So we can take that distinction between stimulus and relief and apply it to the situation now. As the relief programs expired over the summer and the pandemic continued on much longer than I think a lot of people initially thought it would, the same estimates show poverty increased each month since June, even as the unemployment rate decreased and even as economic activity picked somewhat up, at least leading into the winter months. Poverty rose by about 2.4 percentage points from June to December, and about an additional 8 million people are in poverty. More than 18 million Americans are receiving unemployment aid. Around 4 million people have been unemployed for more than 27 weeks. And so debating stimulus policies, which are supposed to increase economic activity by some multiplier, doesn't make sense yet in this context because the pandemic is still ongoing. We need people to social distance and stay home. The vaccines aren't yet widely distributed, and households and businesses still need relief. So applying that to one of the policies being discussed, like another round of direct payments of $1,400 to top off the most recent $600, the Joint Committee on Taxation estimates that would cost about $463 billion. It would likely benefit around 158 million households, including many who aren't under serious financial distress due to the crisis. One idea, and this has been pointed out by Doug Holtz-Eakin, is that instead lawmakers could target additional payments to households that truly need the relief, such as those that are unemployed or those that are long-term unemployed. And that's a population that's closer to about 10 million people as opposed to 158 million. And that difference indicates that relief could either cost a lot less, or it could be much more robust for the households that are being affected by the crisis. So to wrap it up, the broader relief measures happened with the most speed, and the more targeted measures took more time and difficulty to implement. Better IT infrastructure, funding, and information sharing across government agencies could improve outcomes in the future. And the problems also highlight the need more generally for simplicity across the tax system and for lawmakers to prioritize simplicity as they think about additional relief measures. And until the public health threat is mitigated, lawmakers should focus on getting relief to the households and businesses still experiencing financial hardship, rather than trying to think of stimulus policies that would increase economic activity while we're still in the middle of a pandemic and households and businesses still just need relief to bridge the gap until economic activity can resume. And with that, I'll turn it back over to Scott.
Thank you very much, Erica, and thanks to all the panelists. And maybe, Elaine and Kevin, we can pick up on a couple of those points of the dilemma or the challenge of balancing speed versus accuracy. And, on the one hand, Elaine, you were talking about the holes that were left, the people that were missed, and as many as 20 million, you said, not eligible for some of these things. Interestingly, my mom got one. She lives only on Social Security, and she was at least, they knew of her because she's a Social Security recipient. But as you say, there were a lot of other people who are outside the system. During the last recession, it was the Making Work Pay credit encouraged a lot of people to then become filers in order to be able to get that. Do you expect that to happen again this time? But in a way, that's almost too late for a lot of these people. If they were trying to get benefits last year. Anyway, that's kind of a wide-ranging, maybe not even a question, but how do you balance this challenge of speed versus accuracy? And then as Erica mentioned, getting it to the people who need it and not people like me that don't need it.
So I think it's always subjective who needs assistance and who doesn't. Do I care about the $200,000 earner whose income was cut in half? Maybe, maybe not. There's some people who are clear losers and clearly in trouble. That 10 million people who are on unemployment, they're certainly, in a lot of trouble. I think they, are definitely needy of help. But I'm guessing that it's somewhere between 10 million and 158 million that we could come up with a definition of who else is in need. I do think, what you're pointing out, people are going to be filing their 2020 tax returns in the spring, in a couple of weeks. And, many more people are going to be encouraged to file than ever before to come pick up those payments. Do they help buy groceries that I needed 6 months ago? Absolutely not. If I'm still in trouble, though, certainly they can help moving forward and fill some of that, relief role that Erica was talking about. I do think, though, it's not discussed a lot about what a burden this becomes for the IRS. So it's not that I don't think they can handle it or should handle it, but they ought to be resourced appropriately to handle it.
Yeah, I think that's a fair question. And Kevin, I mean, you and H&R Block work so closely with the service. How does this stress the system there, and what lessons? I mean, you alluded to some of those lessons that could relieve that stress, or at least allow them to be more responsive and not burden them. We often complain about the IRS, but I don't think we quite appreciate the challenge that they face, especially when you have legislation that's passed the way it is, and oftentimes, as you mentioned, is so inadequately defined. It leaves them trying to make up rules at the last minute. So how might you help them respond better to these kinds of situations?
Well, it's something that, yeah, Erica and Elaine and you all touched on it, is the idea that these are all adding additional responsibilities to the IRS, and the IRS isn't exactly overstaffed to the point where it just has a whole bunch of responsibility it needs to take on in order to fill its day. You know, maintaining the tax code, ensuring compliance, and processing tax returns is a full-time responsibility that the service has to do, and it has to do timely, and it has deadlines set by statute in order to do that. And you know, when something like EIP comes along and there's a requirement to get the payment out and a need to get the payment out as quickly as possible, obviously it's beneficial for the individuals who are eligible for those payments who do need it to get it right away. But I think just as important, it's working with industry partners to make sure that, you know, any hiccups in the system, for example, if someone is eligible for an EIP and, you know, they have a bank account, but we'll say for some reason the bank account, you know, the number that the IRS has on file is not correct, but, you know, whoever they filed their tax returns through would have the correct number and be able to provide the correct information. It doesn't do any good to process that right away with the information that the IRS has and have that get rejected and either sent back to the IRS, and they get that, rather than getting a direct deposit right away, which is of course what we all want and desire, because those are the ones that you can receive within a couple of days. They're subject to paper checks, which can get, you know, weeks and weeks out in terms of how long it takes to process those. The IRS at a point during the pandemic had to estimate how many returns they had on file based on weighing the amount of paper they received. You know, and then so that's how they estimated. And so that's when you put extra stressors on the system, that those problems begin to crop up. So obviously speed's great, but there are limitations, and there are industry partners that the IRS can rely upon to help them process these types of great need-based items.
You know, Elaine, you mentioned a possible solution of reoccurring payments, and I'm not sure if you were mentioning or referring to the monthly payments that have been discussed recently with refundable tax credits. There was an experiment of that with the EITC a number of years ago that didn't work out so great. There's been a fascinating debate between different tax analysts. One fellow, Matt Bruning from the People's Policy Project, is saying, hell no, we don't want, you know, these kinds of refundable tax credits and things like that. And he says it would be a train wreck. You have a fellow from the Niskanen Center who says, no, these are great ideas, and this is a way to help solve poverty. And how do you navigate that? Learning the lesson from the EIT experiment, but then this problem of people only getting the help they need a year after they need it when they file their tax return.
Yeah, so to set the stage, we did some work at the Urban Institute where 64% of low-income households have at least 1 month in the year where their income bounces up by 25% over their average or drops below it by 25%. And 40% of households have that happen in 6 months of the year. So the picture is, in low-income families, incomes are bouncing around. You're typically not low income because you have the same job that pays low wages all year long. So then we have to, as economists, we try to think, you know, what is the harm to that? And the harm for children is clear. When children are in poverty, their brains are not developing. They are not growing at the rates they should be. It's very compelling evidence. And so then we say, do we have a way to smooth this out? And the advanced EITC did not work. It was a small program that was run through employers, and people were at great risk of not actually qualifying for the benefit year over year, which meant it was risky to take it in advance because you'd have to pay it back to the IRS. So you're sort of tangling up with your employer and you have this payback threat. The program being discussed now is the child tax credit. So the child tax credit goes to, I think it's 90% of families with children receive a child tax credit. So there's very little risk that you will get it in advance and have to pay it back. That will happen when the child moves homes or, in divorces or, family, things like that. But for most, there's an awful lot of children that will be with the same parent year over year. And so we can deliver a benefit and be confident that it won't be owed back at the end of the tax year. So the fact that it's broad-based and, a steady, population helps relieve some of the fears. There's also the discussion now is that the IRS or another agency in the government would pay it out. So you wouldn't be making claims through an employer, which might be more comfortable for individuals. I think Matt's issue is the way the credits are structured now, which they phase in with income instead of giving the highest benefit to the lowest income families. That's also something that the HEROES Act redefines. It says everyone with a child that's low income gets that maximum payment. It's no longer tied to work. So that sort of relieves some of Matt's fears with the payment the way they are now, although he probably has other fears as well. So in my mind, it's a good broad program. It emulates a lot of what other countries do. For example, Canada has a tax credit that goes out monthly for families with children, as do many other countries.
Erica, what are the chances many of these programs become permanent? We've seen a gradual expansion of the EIT, the child tax credit. Of course, I remember 1997 when it was first enacted, and it was $500, and then it was made $1,000 in 2001, and then made partially refundable, and then made $2,000 in the Tax Cuts and Jobs Act. So it has been a growing program. And what do you foresee in that and its sort of evolution?
Yeah, I think there tends to be this pattern that happens where there's a downturn or a crisis, and we use tax policy as a tool to address the crisis. That tax policy either becomes really well liked or is very popular, or it's just hard to actually allow it to expire. And so it either falls into the tax extenders trap, which is the expiration comes and Congress kicks it down the road one more year or 2 more years, and there are about 30 policies that are tax extenders right now where that happens. I think if we see an expansion in the child tax credit or the EITC for 1 year, like is being discussed, that there's a very high likelihood that that becomes either an extender or some form of it gets made permanent. I don't think it's very likely that we would see a really large expansion and then that would go away in 1 year.
I want to get to some of the questions that are being posted and sort of the lightning round. Janet Moyle asks, I'm curious if the legislation opens the door for discussions on loans being considered as income. Kevin, any thoughts on that?
I would not foresee that. I mean, the tax-free treatment of loans is pretty long established in the tax code, as well as the tax implications of loans themselves being income, as well as repayments of the loan being deductible, is outside the scope, I think, of what anybody who's drafting this legislation contemplates. So no.
There is a question here also about the interaction with state legislation. I won't get into all the details, but that has been an issue in many of these programs. And, Kevin, are your clients seeing some of this where there's confusion between the federal rules and then how states are trying to implement it on their end?
Yes, mainly because there are 50 of them and they all have different rules. But yeah, there's a great deal of interest and concern about whether they conform to all the changes made by, like, I know when PPP loan forgiveness first happened, there was a lot of concern in various states that don't automatically conform, whether that forgiveness would be taxable at the state level, even if it wasn't taxable at federal, just as an example. In addition to the types of issues we're seeing with just conformity and tax treatment of the various tax changes, you're also seeing, individual behavior change as a result of the pandemic, where people, all of us we're not actually in Washington, D.C. at a conference right now. We're doing the seminar from our various places of residence. And so that behavior has continued, and that has great effects on individual tax liabilities going forward as well. And it also may force states to change the way they administer their taxes as well. And that's sort of a to be continued part of the argument.
Well, there is a question here on how do the dead return tax payments? And I don't know if I have an answer for that, but we do know that they can't take it with them either. So, well, maybe we can, let's round it out as we're heading up to the witching hour here with a kind of a broad question, which maybe Elaine, you touched on it in some of your comments, and this is kind of for each of you. Which provisions provided the most effective relief for individuals and why? How could that be improved? Or maybe, as Elaine, you alluded to, this just has to be a basket of things based on different needs. Any thoughts on that, Elaine?
Yeah, so I guess I would say it depends who you were. If you're a worker who was all of a sudden made eligible for unemployment, so a gig worker was a good example, and you got, the $600 bump in benefits, that was pretty substantial, and it definitely helped people out of poverty. The work that my colleagues at the Urban Institute did show that those CARES Act payments were the biggest driver of moving people out of poverty, and a second HEROES or HEALS Act style payment, or even a third payment, would have even more effect. So if you're concerned about very low income families, those are the payments that did the most to bring people out of poverty. But I do agree with Erica that they went to an awful lot of people who were likely not struggling.
Yeah. Kevin, thoughts?
Well, I do know, obviously, I've spent a lot of time talking about the EIPs, and that was the big, from H&R Block's perspective and my perspective, it was the most impactful. Like, I want to say if it's the best or the worst or anything like that, but just the sheer number of payments going out under that program is something that, Scott, you've mentioned, your family got payments and things like that. It touched everybody's lives in some way. So that's definitely something we're working through. I do want to touch on the business provisions because I wanted to mention, in addition to the PPP, Scott went through all those acronyms at the beginning, and I'd be remiss if I didn't, talk about them a little more. But the Employee Retention Credit, or the ERC, that was another big benefit to businesses, especially businesses that had employees. And one of the big points of confusion, and we see it with the PPP expenses too, that I talked about, is these laws keep changing over time, because there's a certain set of laws that came out with the CARES Act back in March, and then the CAA passed in December, created wrinkles in all these laws. For example, the PPP expenses that I talked about. Well, we had been telling people for 9 months that they couldn't deduct those expenses. Well, now all of a sudden they can deduct those expenses. And they come back and say, hey, Kevin, why did you give me bad advice? And I say, well, I gave you correct advice until it was incorrect. And another example is the ERC. Previously, you had to choose between essentially taking the ERC and the PPP. You couldn't do both. You could either claim that quarterly credit or you could get the loan. Well, the CAA created a situation where you could actually qualify for both. So look, I'm making up a number here, but if 10,000 businesses took the ERC, now, because you can take both, maybe 200,000 businesses claim the ERC. And then that's retroactive back to when the CARES Act started. So if businesses had a substantial decline in their profits year over year, they're suddenly eligible to claim, potentially tens and thousands of dollars in credits against their payroll taxes. And that's a very impactful part of the law that I think is easy for people to get confused upon, whether you're a novice taxpayer or a sophisticated business, because it keeps changing.
Thank you. Erica, any final thoughts?
Yeah, it certainly wasn't the biggest part, but I think the expansion of unemployment insurance to gig economy workers and others is pretty important. That's a growing size of our workforce and becoming more and more important to our economy. So seeing lawmakers think about how to get relief to that sector, I think is important and has implications going forward. But then I'd echo again, the economic impact payments reaching more than 160 million households had a huge impact. There's kind of a popular temptation online to say, oh, all Congress did was give me a one-time payment. So I don't want to fall into that trap. I think we've seen that Congress did a ton, enacting, more than $3 trillion of support in less than a year. And the statistics showing that personal income rose, even though we were in the middle of the deepest recession we've had in decades, I think is a testament to the fact of a successful relief effort.
Very interesting. Thank you very much. Thanks to all of you, Elaine, Kevin, Erica, and most of all, H&R Block for helping to sponsor this program. Something tells me we'll be back talking about this in about 6 months. I don't think that this is an issue that's going to go away, but it will be something all of us will be monitoring with great interest. And thank you for tuning in today to another of the Tax Foundation's Talking Tax Reform webinars. I'm Scott Hodge, President of the Tax Foundation. Thanks for joining us, and be safe.